When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Vogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Vogan. And now here's Jeff Vogan and Jeff Shade.
Thank you so much. Welcome to Premier Retirement with Jeff Vogan, the radio show that gives you the straight talk and honest answers you need to reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about the June retirement moves smart retirees are making right now. We'll also answer listener questions, and then finally, how 2026's retirement rule changes have shifted your savings. My name is Jeff Shade, and I'm just here to ask the questions. But the words of wisdom and solid advice, they come from the other Jeff in this radio program. It is Jeff Vogan, founder and president of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great. Always fun to be with you.
And it is great to be with you as well, too, Jeff, and of course, all the fine citizens here of the greater Tucson area. Jeff, it's hard to believe that we're already halfway through the year. A lot of people start January with financial goals and retirement resolutions, but then life gets busy. Why is June such an important checkpoint for retirement planning?
I think it's mainly because in the middle of the year. The other thing is the markets tend to kind of go soft and weird in the summertime just because there's lower volumes, a lot of people taking vacations, a lot of people on Wall Street have families, and so they take vacations when their kids are out of school, or they just want to get out of the heat and go someplace cool maybe, or go hang out on the beach. But that's vacation time typically in summer, and so might as well don't take a vacation before you at least check your portfolio, make sure things are headed the right direction. Markets are in kind of a weird state right now, and certainly good to maybe reevaluate your risk, take some profits off the table if you've done well in the last year or so. I think that rubber band stretching that's going to pop when I refer to the market is getting weirder and weirder. We're seeing markets go up huge numbers with little volume, which means the institutions aren't really taking part in these latest rallies. It's mostly just excited, impressionable street investors, basically Main Street investors that are moving the markets right now while other people are going to cash. So I think if nothing else, not just because it's June, but just because what we're seeing in the market lately, we had a nice IPO with SpaceX. They put some restrictions in the sell-off, so it didn't crash right away, but it looks like the NASDAQ's going to have to pick it up, so they'll buy some, so it might stay strong for a little bit. It was fairly uneventful, didn't really rock the markets either way like we thought it might. There's just some things that are happening that I think it's worthwhile looking at your portfolio every now and then, and mid-year is a good time, especially if most of your financial updates are at the end of the year when you do tax planning or a tax review, or you start your year off with new goals. Let's see how you're doing halfway through. Are we still on track? A little behind the action? Do we need to make some tweaks? Or do we just let it ride for the year and bite it off one chunk at a time annually, which is what most of our clients do, because there's always things that happen. And if you have a good advisor that's watching out for you, he's going to be, or she is going to be looking out for your assets while you're on vacation, hopefully. But it's always good to check in on your portfolio. If you have any questions, visit your advisor and make sure that you feel comfortable with the plan that you're on and that it's going the direction that you want it to go.
Well, June is really the halftime report for your retirement plan, Jeff. And the good news is that you still have 6 months left to make meaningful adjustments. One of the first things that a lot of advisors recommend is reviewing your investment portfolio here in June. What should people be looking for here at the halftime?
Well, like I said, the market is somewhat seasonal, so we might see some softness in the market, or you might see some weird things happen. It doesn't necessarily mean you have to jump ship and change horses, so to speak, but it's also halfway through. Are you okay with the risk tolerances that you've set for your portfolio? Have you made enough to pay your bills? Have you taken the profits off the table when they're there? Have you got enough in, you need to replenish your cash accounts or your little emergency funds because you spent it on an air conditioner last month or whatever, and maybe shuffle and kind of rebalance the bucket, so to speak, in your plan. So you don't have to do only annual reviews, and you don't have to do weekly reviews. I mean, if you do a semi-annual review, at least look at things, make sure you feel comfortable with it. That's great. If you need a check-in with your advisor, most advisors are happy to do it whenever you feel comfortable doing it. Halftime is a great time. So June, July issue, in that time frame, we're halfway through the year. The next big event is probably going to be your tax plan, whether you do Roth conversions, whether you take a little extra money out of your 401ks or IRAs and pay taxes on them now because you can fill that lower tax bracket that you're in instead of going into a higher tax brackets later. That all kind of happens at the end of the year, but it's good to take a look and see where you're at. Some people are at a place where maybe they've needed some money and maybe have already overextended their withdrawals from IRAs and have to make a different plan for their Roth conversions and things like that at the end of the year. But again, we can revisit that at the end of the year. We can also revisit it at the beginning of the year and in the middle of the year. But it's just good to review. I don't know that June has any more significance than August or April if you have a concern. If something's happened in the market, if something happening with your situation, nobody has those big events or financially altering events that happen in June or in July or in January or December. They happen whenever. So when those big events happen, you've got to come up with some money. You've got an expense that you need, or if someone passes away or someone gets sick, or you need to help a child out because they get in trouble, because we always seem to want to do that, even if it is with our money, and hopefully it doesn't jeopardize your own retirement plan to do that. But there's those things we have to review. They never happen, like I said, at the beginning of the year, in the middle of the year on schedule. But if those things do happen, that's another time to call your advisor and make sure that your plan is going to handle the stresses that could be put on it from a variety of different things. But again, it's also nice to just review your plan when tragedy isn't striking or when those stresses aren't happening, when you could just go in calmly and say, hey, we still on track. What if the market stays flat for the rest of the year? What if interest rates do go up? Should I buy my car or refinance my house now? No, I shouldn't probably do anything on financing anything right now with interest rates as high as they are. But there's all kinds of different questions that you might have for your advisor that correlate with your plan if you have one. Unfortunately, I see most people don't even have a plan. All they have is, a portfolio, and they look at it and they're happy when they make money and they're not happy when they don't make money. And sometimes they don't know why. Honestly, I don't always know why. The market's kind of a weird thing, and it does what it wants to do, and it doesn't do it when we expect it or when it should, but things do happen. Bottom line is there are some trends that your advisor can help you probably look through and talk through and help you feel comfortable with where you're at. And if you aren't comfortable, then definitely make some tweaks and make sure that you can ride the rest of this year out with a little bit of peace of mind.
Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management right here in Tucson and Mesa. We're talking about a June checkup for your retirement portfolio. And again, if you'd like to sit down with Jeff on a one-on-one basis and talk about your portfolio and see where you are here halfway through the year, call 520-780-9059. You can make that call this weekend if you want. Leave your name and number, and Shelley will call you back and set up a time for you to sit down with Jeff at no cost and no obligation. Once again, that number is 520-780-9059. We talk about allocation once in a while in this program, Jeff. Can you explain the difference between rebalancing and reallocating?
Well, you can call each probably the same thing if you want to, but to try to delineate between, divide them into two different definitions. Rebalancing is if you already know what your allocation is, you want 40% in growth funds and 40% in income funds and 20% in money market safe stuff, and growth goes crazy. Maybe it's taking 60% of your portfolio. Well, rebalancing just means selling the 20% profit, reallocating it back into the allocation that you chose, 20% safe, 40% income, and 40% growth. And we rebalance, sometimes daily, just when we make a trade. We try to keep in balance because we want those allocations to be right. Now, asset allocation in Wall Street terms really just means how many stocks and how many bonds do you have. It's kind of like, what's your split? What they call fixed income, which is not really fixed income, or what they call income generating securities, which is bonds, basically. And the thing is, there's nothing fixed or safe about bonds when you can see the 20-year bond go down 30% in a year like it did a few years ago. And it's still down, by the way. And it's still kind of bouncing around because interest rates went up. It makes bond prices go down. So if you ever have to liquidate a bond to pay a bill or something, other than the interest that it might generate, which really on bonds isn't super attractive for most people, barely keeps up with inflation. That's kind of what it's set up to do. But the allocation is stock and bond and maybe a cash allocation. Now, in our planning, we believe in comprehensive planning. So our allocation has got a lot more buckets, and each bucket has a different job to do. You could have strategic allocations as far as stocks, bonds, and cash in a Roth IRA, but the Roth is an allocation to a tax-free bucket. LIRP, life insurance retirement plans, which we like as an alternative to Roths or as an addition to Roths, I would say more often, is a place where you never get taxed, you never get 1099. It doesn't show up on your means testing for any reason. And it's a different type of an allocation or a different type of an asset class even. So you can allocate between asset classes. And I don't know that necessarily we have to rebalance. Sometimes we do, even on asset classes. For example, we might have some fixed index annuities. That's a principal protected account that can go up when the market goes up, can't lose. One of the types of indexed annuities that we like are index annuities that guarantee income. They call that an income rider or withdrawal, a guaranteed withdrawal rider, guaranteed withdrawal lifetime withdrawal benefit, GLWB, or a variety of different names. Bottom line is annuities can give you guaranteed income, but the new annuities, the fixed indexed annuities that we use, you get control of the asset base. So you can allocate that portion. Let's say it's a third of your assets. You want to go into principal protected assets and have indexed annuities. And you might say, well, I don't need all third of my assets generating extra income because I have a nice pension, Social Security. I have no bills and I don't really need it, but I do want it to grow and I do want to be able to tap into it from time to time. Well, maybe you have only half of that generating a little bit of income. Then the other half you just have sitting there principal protected and grows. It's kind of like the tortoise in the race, not the hare. The tortoise did win the race in the long term, but the hare got ahead quite a bit, just like the stock market gets ahead quite a bit. But over time, you might see that both produce reasonable rates of return, especially on a risk-adjusted basis. So you might have low-risk accounts that are allocated to buckets or categories that generate income or generate risk protection. Or you might have some tax buckets, which might include Roth. You might allocate half your assets to tax-free income, which could be Roth income, could be LIRP income, life insurance retirement income, or it could even be a Roth with an indexed annuity that guarantees lifetime income on a tax-free basis. So I don't particularly like municipal bonds for just a small amount of interest. While the value of that bond could go up or down, I prefer insured, secured asset classes that typically pay more and have principal protection. You might even have a bucket that is for your future long-term care or health needs. Maybe you have a different account for that. Maybe it's an HSA you had at work that you want to leave alone and maybe add a little bit to during your final working years and then just let that thing ride. That could be your allocation to those future medical care expenses. Or maybe your house, which is also the equity in your home, is an allocation. So, if you want to get really broad with the word allocation, just basically how much do you allocate to that bucket for what purpose? And each bucket or each strategy, we have a spreadsheet. So it's each column. And sometimes we call it buckets because people have read books, or an advisor might mention the bucket strategy. What bucket is this? Is this your short-term bucket, long-term bucket, midterm bucket? And that's really just deciding how much risk you want to have in each bucket because you might need that money sooner. Well, that's a pretty, in my opinion, like preschool or kindergarten approach to asset allocation or even financial management. But some people think that that's plenty because all they do is Wall Street stuff. There's so much more out there that you can allocate to, diversify into, not just how many different stocks and bonds you have in an allocation of stocks and bonds in a portfolio, short-term money, long-term money, midterm money, whatever. You can also have allocations or different styles of money, different asset classes of money. Maybe somebody, wants to hedge with gold and silver. Maybe you keep that hard assets in your safe, or maybe you have some ETFs in the market that follow the price of those things because you believe it's an inflation hedge. If I look at history, it doesn't seem to really work that way, but that's what the people on TV say. And so some people might want that. I think we should be in gold and silver when it's going up and sitting still. If it's not sitting in your safe for security or the rainy day in the future purposes, it's okay to sell those ETFs when they're not moving to something else that is. But again, everybody has different desires. The more comprehensive you want to be, it takes a little bit more assets, obviously, to be a more comprehensive advisor or just even an investor. But because most of our clients are affluent and they do have a variety of needs, or they can fill a variety of buckets with their nest egg, then we might as well fill those variety of buckets and use them for all the different reasons that are out there, whether it be income, whether it be tax planning, whether it be emergency funds, whether it be helping the kids out, whether it be a legacy account that my kids can inherit tax-free when I die. What if I have Alzheimer's and need a long-term care facility 4 years before I pass? Where's that bucket? Where's that money coming from? Those are all allocation questions. And the rebalancing might come from, I've spent down my fixed assets living on them, and I've got a lot of profits over here in my Roth IRA. Maybe I should convert some of that Roth IRA into another fixed index annuity to give me some steady income while the rest of it grows. That would be called a rebalancing in a comprehensive plan, rather than just, hey, we got to sell some stocks and buy some more bonds because our stock and bond allocation is out of whack. It could just be, hey, I've spent a lot of liquidity in my Fidelity managed account, and I've got all these annuities that have been just growing nice and steady, and I have some withdrawal ability. Maybe I should pull some of my money out of my fixed principal protected accounts because they've done well, and put them in the liquid account where I can have access to a little bit more of my money instead of waiting till the next anniversary on my annuity before I can take money out. So reallocation is not necessarily reallocating. Your plan typically has all the allocations in it, and you can change the amount that you want in those allocations and rebalance those allocations. In other words, you just put the percentages in each category back to either where it was or to a new place if you want to change as life goes on and life changes.
Our program's called Premier Retirement. We're talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We're talking about a June checkup on your retirement portfolio. If it's been a while since you've looked at your portfolio, you'd like a second opinion, call us here at Premier Retirement and set up an appointment with Jeff. He'll be happy to look at your portfolio and maybe give you a second opinion and see whether you're on track for this year, 2026. Not going to cost you a dime, and absolutely no obligation. The number to get that, 520-780-9059. It's 520-780-9059. Again, it's just a casual conversation with no obligation. 520-780-9059. You can make the call right now if you want. Leave your name and number. Shelley will return it on Monday morning and get you all set up for that. You can also find out more about us online at premret.com. It's PREMRET.com. Jeff, a lot of people think retirement planning is all about investments, but one item on our list is organizing important documents. Why is that so important here halfway through the year?
Well, it's important all the time. It's important, especially that your heirs or trustees or successors know where to find your stuff. My mom has a drawer. I wish she had a fireproof safe because she lives in a place that has a lot of pine trees and could burn up. But more than anything, keeping organized, at least let your heirs know where you keep your papers, where you keep your bills, where you keep your checkbook, all those kind of things. So if something happens to you and you have something on your financial power of attorney, they might need to know where to find your stuff. The other thing is, as I mentioned, my mom lives in a place up in Northern California, not too far from Lake Tahoe, where there's a lot of wildfires. I have a cabin up in Forest Lakes, and there's fire danger up there. For the important stuff, we have a fire safe to take good care of it and protect it while we're not there. But also, if we were there, do you have access or a set of documents that are in a place where you could just grab it and go, like a little hand safe or a bag or something that you could grab and leave with if you needed to? Those documents are pretty important, especially estate planning documents. You don't want to have to redo those. Now, obviously, eventually you're going to get a new statement in the mail from all your bills, so you'll know what those are. And those are probably not that important to do, but wills, trusts, tax documents, I guess you can always get those back from the account if you need them. But insurance policies, sometimes your family doesn't know what all you have, and you don't want to have them have to wait a year till the next statement comes before they realize you had something that could have covered you for that short-term stay in the long-term care facility because you had to recover from a knee replacement or something that could have been insured. So make sure that you have access to all those things, that your heirs and those people that would take care of you know where to find them. I think is kind of the main thing. And if you are going to just take a review of your assets, make sure you have a good place for those assets. Our clients typically get a little portfolio bag, so to speak, so like a little canvas thing that is kind of hard to miss. It's kind of unique to our firm, and those of you who listen and that are clients know what I'm talking about. But if you don't come be a client, you'll get one. But we have a place where people can put all their important documents. Just grab it and go. It has actually some bright greenish yellow trim on it just as a pop. So if it's sitting in a corner, you'll know where it is. Mm-hmm. And we did that purposefully. It's not an alligator skin, Louis Vuitton case that looks all posh. It's just something easy to find, easy to grab, and easy to keep all your stuff in. Many of my clients, they bring them in when they come. They put all their stuff in there, all their statements they want to talk about, all their questions are in there, and they bring it. So that's not a bad idea. Just have a little place to keep all the current documents. You can keep all your old documents, you can shred them, you can do whatever you want with those, but you got to at least have some place that somebody, if something happened to you, could go and grab and know what it looks like or know what the combination is to the safe to where they can find it, where they can get it out, look at it, and make sure that you're okay and that financial matters are still intact if something happens to you and you can't do it.
And Jeff, a lot of those documents are digital these days too, so you don't necessarily need to keep hard copies. I mean, it's a good idea to do that, as you said, maybe in a fireproof safe. However, with digital copies, you can put them on a flash drive, a little thumb drive. You can store them in the cloud, like the iCloud, wherever it happens to be, and get them that way. The important thing is that you have them and that those people who need to find out that information know where they are and how to get at them. Talking with Jeff Vogan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Jeff, let's talk about taxes. Why should someone review withholding and tax planning now rather than waiting until tax season?
Well, tax season typically starts after the first of the year, and you've either withheld or not withheld or made your quarterlies. I'm going to probably buck the trend or maybe even offend some CPAs that recommend other things right now, but I don't like the idea for most retirees to pay quarterly taxes and miss out on all the gains that you could have made on that money throughout the year. Now, the IRS penalizes you if you don't make quarterlies, if you just at the very end of the year make one big quarterly. Some people try to do that. And they said, oh, no, you're trying to buck the system. We want your money and we're not going to pay you interest on it, but we need your money early. Otherwise, we're going to charge you interest that we would have made on your money. I think it's totally unfair, usurious, and all the other bad words you can talk about how they rip us off, not to mention all the stupid ways they spend our money once they get it too. But bottom line is there is another way to not pay quarterlies, and that is you can do a one-time withholding. If you're withdrawing money out of your account for RMDs, or if you're even pre-required minimum distribution age, you can actually reduce the balances of your IRAs, 401ks, and other tax-deferred plans by taking a withdrawal big enough for your taxes and just calling it 100% withholdings. Now, keep in mind when you do that, you're going to pay tax on the withdrawal too. So, I mean, if your taxes are going to be on $100,000 adjusted gross income and you're going to pull $25,000 out, that'll be way too much to probably that you would owe. But let's just say you pull $10,000 out in taxes. Remember, you're going to have to pay taxes on $110,000 now, so you might want to pull $12,000 out to pay the $10,000. But just have it 100% withholdings. And then you don't have to worry about the IRS as a withholding at the end of the year. You know, it actually covers the amount that you have to pay per year. A withholding does not show up kind of like a missed quarterly payment. It just shows up like on a 1099 that you paid and withheld that much in taxes for the year on your withdrawals, and it's all good. So there are different ways to skin the cat on tax planning where you can use your money a little bit longer and get back some of that interest that you would otherwise plan. But you also might want to make sure that in June, like you said, and why is it good to review now rather than just wait till December, decide how much you have to pull out? Well, if you're already taking withdrawals from those IRAs, it might be good to know if you're on track taking those assets out, and if you still have enough left over at the end of the year, not to bump you into a new tax bracket. You know, if you're in a higher tax bracket, let's say you have 200,000 AGI and you take everything out of your IRA all year, but you don't withhold taxes until the last withdrawal, you might end up owing $30,000 in taxes. So you take that extra $30,000 and now you just bumped into a new tax bracket because at 200, you're in the 22 bracket. More than that, you're going to go in a 24 bracket. Not that's a huge jump, but it is a jump, right? Or even worse, what if you're around the 100,000 range where you could, with a couple of write-offs, you're in the 12% bracket, but now you have to do a withholding of, let's say, $10,000 or $12,000, and now it's in the 22 bracket. I mean, that would be a bummer to have to go into that new bracket for all those taxes. And it might be good to maybe restructure how you pull money out of those assets, and maybe you do it through an annuity that has some amount that is not included in your taxable account. You can do a principal plus interest withdrawal where only some of it's taxable and less of it's taxable, or you can withdraw from a trust account or an individual account or a bank account, savings account to live on for a little while so you can save that last withdrawal in the IRA for later. So again, the income plan, how we set it up, already includes that. And in June, middle of the year, is a good time to just review and say, hey, am I on target? Am I taking too much out of my IRAs now? Am I withholding enough? Should I even withhold? Should I wait till the end of the year to withhold? Will I have enough IRA money left to withhold from that? Do the 100% withholdings so I can use all my money and not withhold taxes all year? And will I have enough left that I could pull out without going into a new tax bracket? Is it going to hurt me? Am I on track? So again, tax planning is kind of an all-year thing. If you stick to the plan, it usually comes out just fine if you don't review it in June. But if you've had different withdrawal events where you've had to take some money out of this and that and the other, or you have another need, you might want to revisit it, especially if you've kind of gotten off track and the plan isn't being dealt with to a T. And most people's aren't. Things happen. There's always a couple of adjustments. You got to bob and weave a little bit and be flexible in a plan and leave enough wiggle room to where if something happens, you have to take a little bit extra money out, or even if you have to take a withholding out, that it's enough not to put you into a bad tax bracket or not to derail your plan.
Jeff, great conversation here. I want to talk to our listeners for just a moment. If it's been a year or maybe several years since you've taken a serious look at your retirement strategy, right now is the perfect time to do it here in June. Call Premier Retirement Planning and Wealth Management today at 520-780-9059 to schedule your complimentary retirement roadmap consultation. It's 520-780-9059. Don't wait till the end of the year to discover if you're off track. Take advantage of the second half of the year and put yourself in a stronger position for retirement. Once again, that number 520-780-9059. There's absolutely no cost and no obligation for this Premier Retirement Roadmap. You can also find out more about us online at premret.com. It's PREMRET.com. Jeff, time for a break. When we come back here on Premier Retirement, we're going to be answering listener questions, and then we'll talk about how 2026's retirement rule changes have shifted your savings when Premier Retirement continues right here after news, weather, and sports on 790 KNST, Tucson's most stimulating talk. If you're planning to retire soon or already in retirement, you more than likely have some questions, like when should I take Social Security? How can I avoid running out of money? Or how am I going to deal with taxes in retirement? Premier Retirement and Wealth Management can help answer these questions. They've been designing retirement plans for people like you for more than 20 years. They recognize that you're unique, so your plan is tailored to your individual needs. They'll work with you to determine what it costs to be you in retirement. Then design a cash flow plan, a tax plan, how to pay for health and long-term care plan, estate plan, and how to deal with the uncertainties of life. If you'd like to begin a conversation to answer your questions, call for your no-cost, no-obligation financial review at 520-780-9059. That's 520-780-9059. Or request it online at premret.com. That's PREMRET.com. Investment advisor services offered through Premier Wealth Advisors, LLC, an Arizona State registered investment advisor.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
Thanks so much for making this part of your weekend. You're listening to Premier Retirement with Jeff Vogan. We're here for you each and every week for your fiscal fitness and your financial education on 790 KNST. We're on the air for you 4 times a week here, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and then also on Sundays at 11 a.m. And as always, if you've missed any part of the program today, you want to hear it all over again, we're available for you as a podcast on your schedule. Go to wherever you get your podcast, search for Premier Retirement with Jeff Vogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. You can also Google that, Premier Retirement with Jeff Vogan, and it'll point you towards any number of places where you can hear that podcast. Our number is 520-780-9059. You got a question, a comment for us, or you'd like to get your Premier Retirement Roadmap review at no cost, no obligation, 520-780-9059. It's just a casual conversation one-on-one with Jeff, and we would love to talk to you. All right, Jeff, time for listener questions. Molly is in Rancho Vistoso, and Molly says, "Hi, Jeff. I need to withdraw $40,000 a year from my traditional IRA for the next 4 years. I'm 66 and plan to take Social Security at age 70. I have approximately $200,000 in one mutual fund, $200,000 in a target date fund, $80,000 in another investment fund, $20,000 in another investment fund, and the rest in a CD ladder of $120,000. Am I diversified enough, and what holding do you suggest I pull from when I need my $40,000?
Well, Molly, I hate to say it. You gave me a pretty robust list of stuff, but it really doesn't help me build a plan for you, even tell you, because I don't know what your Social Security is. If you took it now or waited to 70, you're going to wait till 70. It sounds like you need 40,000 a year to kind of bridge that gap. It looks like I would always take it from the least performing assets. I would also, if in the future you may have an issue with RMDs pushing you into a higher tax bracket, and I'm thinking you probably don't. I don't know that it's really critical that you use up IRA funds at this point, but it doesn't hurt. I would use up IRA funds to the extent that you can still have a zero tax bracket at the end of the year, which means you could probably take at least half of that money out of an IRA and take the rest of it out of an after-tax account, like maybe CDs that are coming due that were 5% when you bought them and now are only 3% or something like that. And that might be good. But I think you're definitely on the right track when you say, you want to let your Roth account grow. Absolutely. Let your Roth account grow to as big as it can. It's always the best one to leave for later, or for those emergency funds where you might need to dip into something in a place where you're already maxing out maybe a 10 or 12% tax bracket. You don't want to go into a 20 plus bracket by pulling money out of your regular IRA. It's nice to have that Roth. I would consider also doing some Roth conversions. You probably need a nice little Roth analyzer conversion tool. We have those. The other thing that concerns me is, you've got some mutual funds and target date funds. Typically, mutual funds have a lot of fees in them that you're paying. You could do better in an ETF probably, unless the fund is really good. If you have an advisor that's actually getting fees or commissions on a mutual fund, they're probably double dip in some way with 12B1 fees and some of the loads and charges there. Maybe just straight management with a flat fee and using ETFs and individual stocks might be more efficient for you and I'm assuming maybe you don't have an advisor and you're just kind of trying to do it yourself. So the target date fund might make sense. However, the target date funds I found are very inefficient. You could do better just buying your own allocation of stock and bond ETFs with less fees than a target date fund. The target date fund sometimes actually has funds in them, which also have fees in addition to the target date fund fee. It's just a way to ladder and basically layer fees on you, just like mutual funds can do that. So you probably have more than half of your assets in things that you're probably paying too much in fees for, whether you have an advisor or not. So you might want to rethink that, or even say, gosh, if I'm going to pay these fees anyway, I might as well have an advisor so that I don't have to call the radio show every time I have a question. I hope Jeff gets my question that week. Maybe you have an advisor you can call at any time, whether it's Jeff or somebody else. I mean, it could be anybody as long as you get along with them and they see to your best interest and they allocate your assets into things that have the right risk profile for you. It looks like you have relatively low risk. You've got kind of a moderate portfolio allocation, it looks like. Target date fund, I don't know what target date you have. It's 2030 or 2070. That would kind of determine the risk exposure that you have. I'd rethink that. I mean, you have a nice chunk of assets. I don't know how much your Social Security is going to be and how much you're going to need after Social Security, whether it's going to continue to be $20,000, $30,000. After spending $120,000 or $140,000 over the next few years, you're going to have less to work with. And I would be probably very cautious about going too risky with your portfolio just because the market's way overvalued. And if it crashes and you lose half those assets, it wouldn't be good. Again, the CD ladder, that's safe. You got investment funds and target date funds, not so safe. I don't know what kind of mutual fund you have, whether it's balanced, whether it's a growth fund, whether it's done well, whether it would do well holding up in a crash or not. But you probably need a good, thorough risk assessment, an income plan that gives you a guarantee of at least the $40,000 a year you need, plus some growth with inflation. Then maybe look at how much you want to risk with the rest of it. But again, I said earlier, it might be smart to use some of that CD ladder money because it's not performing very well. But if everything else is at risk, maybe it's good to take some of that risk off and leave that CD ladder because that might be your only no risk or low risk account. So without seeing the whole picture, I'm not going to give you any standing recommendation or anything you should run with at this point, or anybody who's listening should run with. I'm just giving you information that needs to be kind of juggled around here and to figure out how to put it back on a page that shows you a plan of attack here that is tax efficient, that guarantees you the income you need, that doesn't get you into trouble if there's a market correction or a crash, and one that lets you retire and stay retired on your terms and let your money serve you rather than you serve the money or serve the markets or have to react based on what markets do to you. Rather than that, take control and do things that are going to secure your assets and your income from now, not just for the next 4 years, but for the next 30 years or 35 or 40 years if you live that long. Make sure you've kind of looked at that whole picture long term rather than just for the next 4 years.
Molly, thanks for listening to us in Rancho Vistoso. And again, we need just a little bit more information to give you a great answer. And we invite you to call us here at 520-780-9059 and set up that appointment with Jeff. Again, there's no cost, no obligation for that, Molly. 520-780-9059. All right, Jeff, Mike's in Vail, and Mike says, I'm about 8 years from retirement and concerned about sequence of return risk. How should someone begin repositioning their portfolio in the final years before retirement? Is it wise to gradually move some assets from higher risk investments into safer options to help protect their retirement income if a major market downturn occurs?
Well, I think kind of the consensus is to just move a little bit less risky as you go. But I mean, let's just consider sequence of returns risk is a real deal. And I'm glad you brought that up. It's important because you never know. And I talk about it and don't necessarily use the term sequence of returns risk when I talk about the story of Norm, who had, $1 million before the 2000 crash. Engineer, worked for a big chip company up in Phoenix, and he retired at the wrong time, leaving everything at risk. And the market beat him up and he was running out of money. He had to take a job in retirement. His wife and him both had to work. They had to take Social Security early just to make ends meet, and they were almost out of money 10 years later. So I met him after the fact and couldn't do anything to really revive the deal. It was like we're doing CPR on him basically financially just to keep him alive. And you can't really revive somebody who's already died on the retirement mountain, basically. That's kind of another analogy we use is, you climb up the mountain. When you get to the top, you go, woo, it's all downhill from here. But if you don't protect what you've grown, then you could lose it and it could be gone. So 8 years from retirement, and with the market as high as it is, I'm guessing you've probably made a lot of good profits. I don't know what your numbers are, but let's just say you have $1.5 million and you're hoping to have $2 to $2.5 million when you retire. The thing is, if you have $1.5 million now and the market corrects, like it did in 2000 or 2008, even if it's mostly S&P related assets, you go down to 750, maybe you put in another couple $100,000 over the next 7 or 8 years. So now the 750 takes 7 or 8 years to get back to even like it did before. So now you're going to come up about $700,000 or $800,000 short. And if you were planning on having a couple $1 million and being able to use the 4% rule and take $100,000 out of that account per year, the 4% rule is dead, by the way, because of sequence of returns risk. We can go into that in more detail, but again, we'd probably do a whole show on that. Bottom line is risk could kind of hurt you. What if you took $1 million out of that $1.5 million you have right now, leave the 500 at risk, maybe it goes to 250 and grows back to $500,000, but you still have that extra 200,000 or 300,000. Now you've got 700,000, but that $1 million that you took off the table is not just worth $1 million. There are indexed annuities that are guaranteed to be worth at least double that value in 8 or 9 years. And not necessarily that you could cash it out and get that value, but that value is what they would give you an annuity with. And it wouldn't be a 4% payout. So let's just say $1 million right now might be a $150,000 payout for you and your spouse for the rest of your life. That's more than the 100 you thought you could live on the 4% rule. Oh, and by the way, even if the market corrects, you still have $700,000 or $800,000 in assets that you could use. And if you do some careful planning and get them into a Roth account, or even convert them to LERPs and have extra income and extra assets that are tax-free, even better. Now you've got an income plan that's going to max out the 12 bracket, maybe go a little bit in the 22, but have an opportunity to do some conversions and have some tax-free cash as well as that. So you could probably live like a king, pay taxes like a pauper if you do it right. And you might also consider strategizing an income stream with those index annuities I'm talking about that give income. Basically, you create your own pension. The difference with a pension is, you get hit by a truck, the pension goes away when you go away. And if you have a spousal benefit on it, you get less income. And when you're both gone, the balance goes away, even if there is money in there. With the index annuity, that's not the case. If you want income and then you decide, I don't want income anymore, I just want to cash it out, you have access to the balance of that account. So if there's money in there, you can still get it. If it runs out of money, you still get the income. Again, if you or your spouse pass away before you use up the income, then that income is available for your survivors, or for your heirs, for those people you love. So ways to control that. When you're within 10 years, and if you've got a significant amount of money set aside, if you didn't have a whole lot of money, if you only got a couple $100,000, I'd say, keep adding to it, maximize your 401k, do the best you can, dollar cost average in, and let's hope. I don't think taking $100,000 or $200,000 off the table for future benefit probably makes that big of a difference, at least for most of the people we talk to. It may. I'm a year in Vail. Most people aren't poor out there, so I'm guessing you've got a nice little nest egg. So if you want to look at it in more detail, I'm probably more of the persuasion of when the market's high, you never get hurt taking a profit. And if you could guarantee over the next 8 years an income stream that's much bigger than the one you had planned on, then why not lock that up now and then risk the rest, knowing that no matter what happens with the market, you're going to be fine in 8 years and you're not going to have to rethink the decision to work another 2 or 3 years till the market gets back, or decide you can't ever retire because the market blew up and your account still hasn't rebounded and you end up working until you're 75 or 80. You don't want to do that. So I believe in locking in profits. You never get hurt taking profits. I believe in creating guaranteed income streams. I believe in creating a tax-efficient plan where your bills are paid every month before you start risking your life and your livelihood and your peace of mind and your access to cash flow based on the whims of a market that you have no control over. I'm in the market, I manage money, and believe me, I am not in control. There's algorithms and different things that are causing things to happen that don't make a lot of sense right now and haven't for a while. I would never leave my future retirement income to chance on that.
Mike, we appreciate you listening to us in Vail. And again, if you'd like to further the conversation with Jeff, it's 520-780-9059. You can make that call right now if you want. Leave your name and number, and Shelley will call you back during the week and set up that appointment for you. Again, no cost, no obligation. It's 520-780-9059. Next question is from John in Pima Canyon. John says, if I had a Roth 401k for 5 years and convert it or move it to a Roth IRA, is there another 5-year waiting period?
Well, actually there is, but there's a lot of misinformation about that. The Roth 401k does not translate the 5-year starting period to an IRA, interestingly enough. You think it would. But the fact is the tax-free money does convert, and you can convert that entire tax-free account that you have in the Roth 401k to a new IRA, a Roth IRA. Here's a cool thing. Whatever you have already paid taxes on, which you would have paid taxes on all the money in the 401k, Roth, when it comes over, that balance is not subject to the 5-year rule, nor is any balance in a Roth, any account. Anything you've already paid tax on is still accessible before the 5 years are up. Only the earnings on that account are subject to the 5-year rule. Most people don't know that. It's amazing how many advisors seem to not know that, because I get people from other advisors and they're telling me that, well, my advisor said I can't touch this. Really? I don't believe he really said that, but maybe they did because they don't understand it. The bottom line is, and you can Google this, you can plug it in and say, hey, you could ask that question exactly like you said it in your question, and you could stick it in ChatGPT and it'll give you the answer. It'll show you the rules. That's a pretty good tool to have. So now that so much information is available, and it'll talk about the miscommunications. Now, there are some interesting guides out by some companies that have a reputation for being super good at fiduciary duties and all that other kind of thing. And they have these guides and stuff. And I think they're even nebulous or very misleading sometimes. So be careful with propaganda that's sent out by a company that's company specific, because sometimes it's kind of meant to confuse or leave you hanging a little bit so that you call them for extra advice. You can get a lot of stuff done. I mean, as much as I don't like AI and the fact that it's taken the humanity out of a lot of aspects of our world, I like the idea that it's aggregated so much information that these answers are very easy to get. In fact, while I was just saying that, I just cut and pasted into ChatGPT. It says, roll over to a brand new Roth IRA from a 401k. A brand new 5-year waiting period begins. The clock resets to 0 for the earnings portion, regardless of your 401k history. The clock starts retroactively on January 1. Another thing people don't know, they think it's 5 years from the day you open the account. It actually retroactive. So if you open the account in December of a year, it actually retroactives to January. So you really have 4 years and a month to wait to take earnings. So it's based on calendar year when you open the account, as well as that 5-year rule. Anyway, nice question. It's a really good one. I like dispelling the myths and the rumors about the 401k or the IRA 5-year rule, because most people don't understand it. And most people think it's kind of restrictive when honestly, it really isn't. I mean, if you put $500,000 from your 401k into an IRA and you can still use it over the next 5 years, that's $100,000 a year. You just can't take out the earnings. Maybe over the next 5 years, that the $500,000 earned another $150,000. That $150,000 then could be accessed after the 5th year. So in other words, you could do a Roth conversion, use it all up. Now, I wouldn't recommend that. The whole idea of a Roth is you can defer it forever, not pay taxes on it, not get into that RMD trap, and you can pass it on to your heirs tax-free. So Roth IRA is really, if somebody's really curious that, oh my gosh, I have to get at that money right away, I don't think you really have the right bucket plan, or you maybe allocated too much money to the Roth perhaps. Or if you planned on living on it tax-free forever, then you probably got enough money in there that 5-year rule is never going to matter anyway.
John, thanks for listening to us in Pima Canyon. And if you want to further the conversation with Jeff, it's 520-780-9059. Absolutely no cost and no obligation whatsoever. Same number is good if you would like to sit down with Jeff and talk about your journey towards a confident retirement. Absolutely not going to cost you a dime to do that. No obligation as well, too. 520-780-9059. You can also find out more about the firm online at premret.com, premret.com. Jeff, retirement planning seems to get more complicated every year. The rules change, the tax laws change, healthcare costs change. What is the big story for retirees and pre-retirees listening to us here in 2026?
Well, yeah, I mean, we've seen a lot of changes, especially with the new tax laws after COVID, with how you have to take the IRA money out, how much you can put in IRAs as a 10-year period of withdrawal if it's on an inherited IRA. It didn't used to be. Those rules were kind of mixed up, and now I think there's sort of been decided that anything pre-2020 is a different rule than the post-2020 rules on inherited IRAs, that kind of thing. A lot of updates. Let me just go through a few of them. The proactive planning is more important now than ever because of all the changes, rather than just kind of passively hoping things worked out the way you thought they would 20 years ago. Not just the distribution rules for your IRAs, but also us aren't really that old. I mean, shoot, I was already in business. Well, I've been in business 40 years. So, I mean, it's not like they've been around forever, but Roth conversions have been one of the most, I guess, misunderstood things ever. I just mentioned it in the last question about the 5-year rule. If you roll it over, you can't use it for 5 years. That's not true. Tax-free income. You can now get that tax-free contribution available in Roth 401ks now, which hasn't always been around. A lot of companies haven't offered them. That's becoming more and more common. Probably the biggest story is that they've increased the contribution limits as you get older. The catch-up provisions are pretty high. 2026, for example, the 401k contributions have increased to $24,500. Anybody over 50 years old can contribute an additional $8,000 called catch-up contributions. And there's even a little bit extra that you can throw in there if you're between 60 and 63 and if you follow certain rules there. So for many people that maybe were raising families in lower income areas, during their 30s and 40s were in a little bit lower net income stage where they couldn't put away a lot. At least the IRS has opened the door to allow you to catch up and make a little bit of headway now that you're probably in your higher earning years just prior to retirement. That's probably one of the biggest things. So remember to maximize your contributions, maximize your retirement income, and maximize your retirement security.
Jeff, healthcare remains one of the biggest concerns for retirees. What changes are you watching there?
Well, one of the things that's probably the biggest thing that bothers people is the IRMAA, which is really the income adjusted Medicare expense that you pay on Part B. And when you try to do aggressive tax planning after age 65, you typically can go into a higher tax bracket, but also a higher IRMAA bracket. I mean, I have clients that are paying $700, $800 a month for IRMAA because they're either making too much money and maybe they did a Roth conversion, or even if they sold a house and all of a sudden have more taxable income on their tax returns, they get dinged with a higher rate because it's like got tax brackets. IRMAA brackets are different based on income, and it takes 2 years of new tax returns to actually reverse it. The IRMAA, the levels are going up higher and higher. I think the government's kind of bragging about the fact that they're actually getting Medicare budget more balanced. Maybe it is even balanced by now because they keep on raising the IRMAA and they've changed those brackets, and more people are retiring with higher income. And that's one of the things that makes it important to do tax planning, not just for the regular income taxes, but sometimes it's really important and beneficial to maximize Roth conversions, maximize Roth contributions in the last few years of work so you don't have that extra money in an IRA deferred, and all of a sudden you get to be 73 or 75 years old, however the age is, when you take those required minimum distributions out, and all of a sudden it kicks you in a new tax bracket and you can't do anything about it forever. And now all of a sudden you're forced to take money out, pay taxes on it, and now you're also paying double or triple Medicare insurance, and you're not getting any more benefits for it. So the IRMAA or the Medicare is something that changes every year and something that we look at every year, but even more so now, just because so many people are in higher tax brackets, so many people have bigger 401ks, need to do the tax planning maneuvers to do the conversions, either paying the tax on the IRAs to convert to Roths, or even the alert programs, which are more like a stealth Roth where you never get a 1099 on it, you borrow from it instead of take money out. I've mentioned those several times, but again, we have to know what these changes are because it affects the way we plan. Thankfully, there's a lot of good software with, how powerful computers are these days. You can do thousands and even hundreds of thousands of reiterations of when to take money out to get you down to the exact perfect amount each year and to the day when you break even on doing a Roth conversion, or if it's even worth it. Or maybe you only do half of it to a Roth because you're never going to be in that high of a tax bracket anyway, because you already have some tax-free income, or you have a pension instead of a big 401k, whatever. Bottom line is we can analyze the entire structure of your plan and make sure that those Medicare costs don't get out of line. But also with just healthcare, just the costs alone make healthcare a very focused, one of the pillars of planning that we really have to focus on. How much do long-term care facilities cost, and even assisted living? What if something happens to you and your spouse is deceased and can't get you up and dressed in the morning when you're invalid, or whatever, or you're both just, as we get old, we get less able to do stuff. I hate to say it, but it is the next big event after retirement that we have to plan for, is how, as we age, and how we're going to take care of us when we age. And sometimes it means additional health care. Sometimes it means paying for a facility, paying for costs that are very expensive and getting more expensive. So tweaking the retirement plan every year and looking at those changes are important, especially with healthcare, which for our clients is probably the second biggest expense after taxes, which is the first one we talked about.
Jeff, if someone is listening today and they haven't reviewed their retirement plan recently, what should they be doing?
Well, if you're not doing that with your current advisor, get a new advisor or call the advisor and say, hey, why aren't we doing mid-year reviews, or do we need one? And maybe you don't. I would say that all my clients who are listening are thinking, oh my gosh, do I have to call Jeff? We need a review. Well, chances are we're already reviewing during the year, because we also, have reviews anytime like a LERP anniversary or an annuity anniversary comes due. And typically they're mid-year, because we do a lot of business mid-year, but we do the planning on it on a calendar year basis. So, if you're already coming in for reviews and you've had one recently or are going to have one, you probably don't need to run out and do it. But so many people that we get in here don't have advisors that really have a set plan for reviews. They just talk if they need it, or they just have an annual review during tax time and don't really have a plan that goes along with it. So, if you want to review what you have, feel free to reach out to us. We're kind of slow in the summertime because a lot of our clients are up in the mountains. We try to be up there too, by the way, but happy to, for those that are here, come in, get a second opinion and see if there's any tweaks that you need to make. And maybe you just need to see where you're at on your present plan and see if you need a more comprehensive plan where you can use more of the tools that are available and build a stronger financial house with a stronger foundation that'll keep you sheltered from the storms that might be ahead.
Folks, if today's conversation has taught us anything, it's that retirement planning isn't a set-it-and-forget-it proposition. The rules will change here in 2026, and chances are your retirement strategy should be reviewed as well. So whether you're still working, you're approaching retirement, or you're already retired, now is the time to make sure that you're taking advantage of every opportunity. Call us here at Premier Retirement Planning at 520-780-9059 and schedule your complimentary retirement roadmap review. It's not going to cost you a dime. 520-780-9059. You can also find out more about us online at premret.com, premret.com. Jeff, we just get started and we run out of time. So for Jeff Vogan, I'm Jeff Shade. Thanks for listening to us today. Have a great weekend and be sure to join us again next week right here for another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.